guys, today we're going to talk about a really important topic, that is, what are the main tools the Federal Reserve uses to influence the economy and how does it do it? We will also learn the tools that the Fed uses in its new monetary policy and how they differ from their old way. Don't worry if you're not familiar with economics, because I'm going to break it down step by step in a simple way. So let's start. What is the Federal Reserve? Well, it's the central bank of the United States, and to put it simply, the Federal Reserve or the Fed is like the bank of the US government. If you look at the Federal Reserve website, it says one of the most important functions of the Fed is to promote economic stability using monetary policy. The Fed's goals for monetary policy, as defined by Congress, are to promote maximum employment and price stability. This basically means the highest level of employment that the US economy can sustain while maintaining a stable inflation rate of around 2%. So, how does the Fed control the economy? The Fed has some tools to control the economy. These are called monetary policy tools. Imagine the economy is like a car. If it's going too fast, it might crash, then the Fed can step on the brakes. If it's too slow, then the Fed will press the gas pedal. So let's understand how the Fed works. The Federal Open Market Committee, or the FOMC, is like the money boss of the Federal Reserve. They meet in Washington, D.C. 8 times a year to talk about the economy. They look at economic data and statistics, talk to economists, and decide how much interest banks should charge each other. Now, this interest is called the federal funds rate. So, this rate is the bank's overnight lending and borrowing rate from each other. This rate matters because it affects how much regular people like you and me will pay for cars, houses, etc. So, if it's too low, things are affordable, and if it's high, things become more expensive. So, let's understand this step by step. So the banks have to hold some money at Federal Reserve and they earn interest on it. Sometimes one bank has extra money that it can lend to another bank. So the bank with extra money can lend it to the one that needs it. The important part is that the interest rate for this lending is not decided by the big boss of the Fed, but by the banks themselves. They agree on a fair rate, and this is market determined. So how does the Fed steer this key interest rate in the target range set up by FOMC? The Fed uses two administered rates. The first is the interest on the reserve balance, and the second is the rate on reverse purchase agreement. These are their main monetary tools to control the federal funds rate in the current times. According to the Fed Chair Jeremy Powell, the Federal Reserve sets two overnight interest rates: the interest rate paid on banks' reserve balances and the rate on our reverse repurchase agreements. We use these two administered rates to keep a market determined rate, the federal funds rate, within the target range set up by the FOMC. When the FOMC wants the Fed funds rate to go up, the Fed moves the interest on the reserve balances up. This rate sets the lowest rate that the bank would be willing to accept to lend money to anyone. Since bank can also earn this interest by depositing their money at the Federal Reserve, and keeping money with the Fed is the safe way to earn money, banks prefer to do this rather than lend it to another bank at a lower rate. So this acts as a floor for the federal funds rate, which basically means that the bank will not accept any lower interest rate than this to lend money to another bank. Another important concept to understand here is called arbitrage, which is like making a profit by buying low and selling high. So let's say the federal funds rate is 5.5% and the Fed pays 6% for the deposit to be kept at Fed. So the banks can borrow at 5.5%. This pushes the federal funds rate up until it's close to the interest on reserve balance rate, which is 6%. Similar to this concept, which is just for the banks, Fed also has other tools like the overnight repurchase agreement facility, which is the interest other broader financial institutions can earn by keeping the money at the Fed. Thus, this also serves the same purpose as the interest on reserve balance do for the banks. So it basically means that the federal funds rate cannot go below this. The other tool the Fed uses is called the discount window, because banks will not likely borrow at a higher rate than they can borrow from the Fed. This acts as a ceiling. It is set higher than the interest on reserve balance rate and the overnight reverse repurchase agreement rate. So these are the two tools that the Fed is using now in the ample reserve case. The Fed's tools before the 2008 financial crisis were something called the open market operations, where it bought the treasury securities to pump money in the economy. However, after the 2008 financial crisis, it has ample reserves now that it only buys government securities to make sure that the reserves remain ample in the banking system. So it uses this open market operation as a supplementary tool. So how does the FOMC decide on the target interest rate? Economic data on inflation and unemployment helps the FOMC decide its target interest rate. Over the years, the FOMC has been changing this federal funds rate target range up and down to help the economy. So think of it as a knob to the music player. When the economy was in trouble after the 2008 financial crisis, the Fed turned the volume down to zero back into 2015. Then when the COVID-19 pandemic happened, they again turned the volume back down to almost zero to help the economy during that time. Now, most recently, since last June 2022, the Fed has been raising the interest rate to control inflation. As of today, the target range for the federal funds rate is between 5.25 to 5.5%. So think of Fed as a DJ for the economy, and it turns the knob up and down to keep the economy running smoothly. I hope you found this video useful and gained some knowledge on how the Federal Reserve in the United States control the economy by influencing the interest rates. If you like video like these, please give it a thumbs up and write in the comments below what would you like to hear next from me, and I will see you soon in my next one. If you haven't subscribed to my channel, please subscribe to it if you like my content, and don't forget to hit that notification bell so that you can stay updated on whenever I post my content. Take care. Bye.